I probably can't repeat it the same way. Just to see if we can match. Can we find a public bank or somebody who can do a match program? So 10 or 15 Treasury employees, they will match that.
Ms. Pence?
Here.
Ms. Shakarian?
Here.
Ms. Rodriguez?
Here.
And Mr. Corrigan?
Here.
Before we go ahead and start with the finance committee report, Trustee Corrigan, we have our fine folks here from PNC who are going to go over our endowment portfolio.
I'll give a quick
Okay, please.
introduction. This is John King. He's the Senior Investment Advisor from PNC. He has now replaced Glenn Donahue, who has been with us for many, many years. And along with him is a colleague of his, Kayla Peters. And they're going to briefly give you an overview of how the endowment portfolio performed last year in 25, and then give you an update on how the first quarter is going in the endowments.
Caleb, you want to take us away?
Provide a brief context of market backdrop before John goes into your portfolio's details. So I have some prepared remarks. Feel free to interject if you have questions. Are the slides showing on the screen? There we go. If we could flip to a few slides down. One more, starting on page 5. Markets have had a lot to digest over the past several weeks. Geopolitical conflict, shifting Fed expectations, and significant headline volatility. Against that backdrop, here's how we're thinking about positioning. On the geopolitical front, we're not recommending clients make decisions based on the war in the Middle East. Reactionary moves risk landing on the wrong side of fast-moving headlines and situation changing seemingly every other day. One area where markets have formed a broad consensus is the Fed holding rates steady for the remainder of this year. Coming into this year, our expectations was for 2 rate cuts. We've suspended that forecast and now believe the Fed will remain on hold for the remainder of this year as it evaluates incoming data on inflation and the labor market. One trend that we do view constructively in the medium to long term are implications of AI-related innovation and developments throughout the economy. This remains a durable theme regardless of the near-term noise. If you'd flip to the next slide, please. The US has been the primary beneficiary of the AI innovation to date, and last year the markets focused their attention on the dollars being deployed into these investments. This year, we believe there'll be a shift of markets' attention toward the outcome that these investments have in the material economy and the profitability and growth of businesses. Amid higher energy costs, we expect growth to moderate this year through the U.S. being better positioned than most given the energy independence and security. Fiscal policy as passed last year also provides a cushion for businesses and consumers in the near term and helps offset some of the war's immediate implications in the U.S. economy.
You consider the war one of these geopolitical disruptions that you told us about in the previous part here.
Yeah.
I was hoping you were going to get to that in this one.
And among developed international markets, the disruption is a little bit more acute. The more lasting implications of the war in those markets is a continued shift away from austerity, which has dominated European and Asian markets, and toward more fiscal stimulus. Our expectation is that priorities dominate around defense spending and energy independence moving forward in those countries. Internationally, the picture differs meaningfully in emerging markets, and this region has been especially sensitive to the headline implications of the war. Our investment thesis in emerging markets centers around Asia and specifically China as a sustained leader in technology and innovation, and a trend we expect to continue for several years in the future. Next slide, please. Turning more to the immediate impacts of the war, the U.S. and global crude prices showed an initial shock, but taper out when you look further out into the future based on contract prices, reflecting a broad consensus that the conflict will remain relatively short-lived.
If I go far enough, is that what you're saying?
Yeah, it's page 7.
It should correspond to page 7.
I did already, but I didn't see those charts.
You may be looking at an earlier version.
Oh, I might have been, because I looked at this yesterday. Okay.
Context and news is changing so fluidly. We want to provide
Start over.
the most recent update. Moving our attention to kind of treasury yields, these have shifted higher recently and reflect the bond market's expectation that inflation risks are skewed to the upside in the near term. Equity markets have trended lower as expectations for rate cuts were removed and bottomed earlier this year when markets briefly priced in the possibility of an actual rate increase, but have since adjusted back with recent developments. Our view is that equity prices will ultimately be tied to business fundamentals, and right now, those fundamentals remain well positioned. Notably, earnings estimates this year remain largely unchanged, and we'll be watching whether these get revised in the medium term as the picture becomes clearer. But for now, the underlying story remains constructive among equity investors. So with that context, I'll pass it on to John to talk about your portfolio.
Okay.
Thank you, Caleb. My name is John King, and it's a pleasure to be able to work with the Cleveland Public Library's endowment at PNC. If you could advance the slides to the, let's see, one more time. One more. And one more? Yes, okay. You can pause there. So Carrie Krenecki asked me to comment on the investment policy for any recommendations that we might have as the board might consider updating the investment policy statement. I think it's a very comprehensive investment policy statement. However, compared with other nonprofit organizations that PNC works with, we tend to see a more deliberate purpose of assets statement in the IPS that the board might consider adding to the investment policy. We also see maybe a more deliberate quantitative spending policy stated. Typically, that's in the form of an annualized percentage of assets. So that might be under consideration. Caleb did include a PNC white paper around spending policy considerations that the board might want to consider or come back to us for further consultation. The last thing I would mention as it relates to the investment policy is that we do see some organizations, not all, have statements regarding what I would collectively refer to as responsible investing guidelines, if that's an interest to the board. Yes, and those ESG, environmental, social, and governance statements can be helpful in shaping the way that the portfolio is consulted or constructed and screened against things that the board, the library would find, objectionable. So typically we see exclusionary screens more so than, say, impact screen, typically. If you want to advance past the investment policy statement to the asset allocation page, that's several pages forward. Here we go. Yeah, okay. That's a
Right
good
there.
page to be on. Okay. So with respect to the asset allocation, I will mention that the broad asset classes are well within the policy ranges according to the investment policy statement. We do have on hand in cash about $1.6 million to basically prepare for any future needs for liquidity. I noted that we did have a distribution at the very start of the year of just over $1 million. Given the uncertainty in global markets, we'd rather have that liquidity on hand. I should mention that while that sits as a relatively unproductive asset, it does earn roughly 3.5% in our sweep deposit vehicle within the endowment. So it is earning some return as we stay liquid there. Right now, our current attention has been focused on the fixed income allocation. We previously had two investments serving as the bond allocation. One was an actively managed mutual fund. The other was an exchange traded fund. The first one was Dodge & Cox Income Fund. The second was the iShares Bloomberg Aggregate Bond Index ETF. We have sold those in the month of April to better control positioning around duration and credit exposure. And then also we were seeking to eliminate the additional fees associated with investing in a bond mutual fund and ETF. So that means that we should be able to keep more of the yield that's generated on the bond portfolio than before. The bond allocation will shift to our PNC Capital Advisors team that manages a core bond strategy that's benchmarked against the aggregate bond index. And I'm happy to follow up with the board on any further information there. But if you're seeing online statements, you'll see that there's some movement and transactions going on as we build out that part of the portfolio. So we're repositioning that.
Can I ask a question?
Yes, sir.
Here? How much exposure do we have to the possible private credit market?
Zero.
So
Yeah.
we're not in any of those.
Correct. No further comments needed. Thank you. Yes. Okay. Advancing slides. Yes, I'll stop here. So keep in mind, we're evaluating performance over the full year of 2025, which was a strong year in absolute terms. The endowment was up 13.82%. This was, of course, very strong for, a well-rounded asset allocated portfolio. However, we did trail the policy benchmark, which is weighted 60%. This is a horrible acronym, but the MSCI ACWI index, that stands for Morgan Stanley Capital Indices, All Country World Index, and 40% the Bloomberg Aggregate Bond Index. So we trailed by 128 basis points that blended policy benchmark for the full year. And this was due to having underperforming domestic active equity manager allocations. When we look at the 5-year average annualized returns on a net of fee basis, we find that the endowment was just 54 basis points. That's roughly 0.5% behind the policy benchmark, which was up 6.32%. Again, returning to 2025, notable contributions to returns came from our allocations to international developed market equities as well as emerging market equity allocations, which were up 33.5% approximately and 32.5% approximately, respectively. So international was up 33.5% and emerging market equity was up roughly 32.5%. Bonds also contributed to returns, up 7.8%, and alternative investments also contributed to returns, up just shy of 9.75%. So very good contributions from most of the asset allocations that we allocate to. Returning to the active manager underperformance, this was led by, excuse me, Edgewood Large Cap Growth, which we subsequently sold in December. Edgewood is a relatively concentrated growth manager, and we observed that they were caught on the wrong side of the artificial intelligence trade. But also their security selection has underwhelmed over many prior periods to the resumption of the AI. But the other thing that I found objectionable was that the manager had a high management fee of 1% of the allocation that we had with Edgewood. So we did sell this to move the proceeds into our passive U.S. large cap exposure, which is anchored by the iShares Core S&P 500 ETF. Edgewood wasn't the only manager that struggled in large cap value, which was more or less out of favor for 2025. They underperformed, as well as GWK in small cap core. Sure. Oh, yep. Next one. I'm sorry. There we go. So here we're looking at the individual manager performance. But Aristotle, we are reviewing their performance. We expect them to do better as large cap value has started to turn around in 2026. And we remain patient with GW and K. Both of these managers have a very disciplined investment process focused on quality. And we note that quality was largely out of favor in 2025 as lower quality companies, particularly in small cap core, rallied on hopes of a series of Fed rate cuts towards the end of the year, which ultimately, hasn't materialized. So, like I said, we'll maintain the positions in both of these managers here. Updating the performance for periods ended March 31st, 2026, which was provided as a separate exhibit. The portfolio is down just 1.5% in the first quarter of this year, and that's slightly ahead of the policy benchmark by about 28 basis points or 0.25%. And that improved the 1-year trailing relative return by about 17 basis points. There were transactions that were made in 2025, notably the Lazard Global Listed Infrastructure investment was sold so that we could make room for new allocations aligned with artificial intelligence investments. And we had also sold about in May of last year a prior international large cap manager and moved that into a new SMA manager, separate managed account manager, Hardman Johnson and Dodge and Cox International Equity Fund. So with that, I'll turn it back over to Caleb to talk about some additional considerations that the board might be interested in learning about. Caleb?
John referenced the 2 white papers that we included in the appendix. The first one is about spending policy. And given our analysis, we'd expect the portfolio, your portfolio, to generate about 6.6% return annually over time. And this is pretty close to what
Lift that so you don't bend your back.
thank you. The returns that the portfolio actually generates is relatively close to this expectation. When setting a spending policy, you want to take into consideration the fees and expenses on the account and our expectation for inflation. When you subtract those numbers from this expected return, you get a return of 3.75%. And so this would be a reasonable, sustainable spending rate that you might consider including an investment policy to set a target that can guide the asset allocation and just draw more clarity around the returns the assets are generating and the mission the endowment is supporting. That's the first paper that you can reference in more depth. The second paper highlights our enterprise financial modeling capabilities. These are included in your relationship with us and offer a way of viewing the endowment within the broader context of the library's financial position and institutional health. It allows you to model out investment outcomes across time and across different scenarios, adjusting spending rates and asset allocation to view key financial ratios and other financial insights that might help guide your better understanding of where the endowment fits in the financial statements and the library's finances. We've seen clients use this in along with their IPS overview so they can decide if their investment strategy continues to align with the organization's financial position or if there needs to be changes made. So just another thing we'd bring to the attention of the committee.
We go from Caleb to John.
Thank you, Caleb. Well, with that, that concludes our prepared remarks. We're happy to take any questions from the board.
Within your services, as we may have questions and counsel on revising our IPS, what have you done lately for other clients related to that?
You know, every organization is unique, and that's the approach that we take with our clients. So while there can be, you know, best practices or certain things that certain organizations might have in their investment policy statements, it's not, you know, heterogeneous or, you know, it's not homogeneous across clients. So we're happy to consult. And like I said, I think this was a very comprehensive, you know, investment policy statement. I think it was notable that we excluded, you know, large parts of, you know, more private market investing, which, you know, I think is probably appropriate, but that might be yet another area that could be reconsidered. But, you know, there's trade-offs there with doing that. So that might not be exactly what the library desires.
And Carrie and Tom, just because I'm a newer board member,
Yeah.
when we last revised it, was there a reason why this specific percentages were excluded and the ESG statement was not considered?
I think it was just a matter of timing at that time rather than, I certainly have no objection to reconsidering the ESG policy aspects. Part of it is, at the time, there was for lack of a better way of saying it, kind of an ESG backlash going on. And we always try to look conservative for our taxpayers.
Yeah.
And so we did not want to be caught on the wrong side of what looked like it was going to be a hotter issue. It tended up not to develop that well, and most ESG policies have gone forward. They all took a publicity hit for a while, but even among the major cap stocks, there's basically much more ESG than people would have expected at this point in time. So I see no reason for us not to be considering and put ESG considerations back in the policy. So, and I don't know if you have a different memory, but that was my recollection of what happened.
No, in essence, that's pretty much what happened.
I always ask the usual questions. We're not heavily involved in any tobacco stocks or tobacco conglomerates.
Yeah, I mean, off the record, I would say that, many of the investments that would screen unfavorably for ESG guidelines are typically not stocks that we're interested in investing usually anyway.
So, okay.
But the S&P 500 is a passive index, of
Right.
course, will have representation
It is
in
some
tobacco
representations
sectors.
because we're buying in block, we're not
Right.
selecting.
Correct.
But we've done no selection of tobacco in particular, and no selection that I knew of at any time in what I would consider other questionable stuff, like there was a huge cannabis-related investment.
Yeah.
And although I'm not anti-cannabis, I didn't think it was appropriate for the library to be there. So is there anything like those things that stick out to you in anything that you've done since the last time we looked at this?
We can do an analysis of the current holdings. We can do look-throughs of any of the funds or ETFs or SMA managers that we have to find that out. I didn't come prepared today to discuss
I
that.
understand.
And then the only other thing I would say about it is if there were that could be course corrected, it would be a very immaterial part of the overall endowment.
That's my view too,
Yeah.
from what I've seen in the past. Even as I look through the lists of where the bond funds that we invest in are, those issues are pretty small in the overall scheme of things.
Yes.
I think we look forward to having conversations with John and Caleb in the same way that we did with Glenn, so we could have those type of discussions and for them to better understand what we would like to invest in. So.
And every time just for future reference, Tom does ask the same questions usually. He just is always making sure that we're have a good view of what we're doing and how the public sees us. So Johnson, you'll know for next time.
The only other question I have is, in the scheme of things, I always wonder, and Dr. Johnson is here, we always like to know where we are in the philanthropic worldview. In other words, of our portfolio, of your customers, are we what you'd consider a middle or a lower third? I know we're not huge.
Yeah, so we recently put out a white paper, which was a study from Nakubo, which I am not going to understand what that stands for.
No.
But we do have analysis around peer institutions
Right.
that we can look to inform next time.
That'd be great. Yeah, I just think that's good to know, because one of the things, again, that is there, the public sometimes looks at whether we're being different from peer institutions is probably the best way
Yeah.
to say it, so.
Yeah, absolutely.
And I guess PNC is obviously a bigger bank than when we first came to you all. I forget how many years ago that is now, to be honest. It's got to be more than 15 that I can think of.
Yeah.
A long time. I was still at the county.
Yeah, you were.
Yeah.
So the question is where of the Cleveland managed portfolios, are we, in terms of size, in the top half or bottom half of what you guys are doing in that
Yes.
regard?
Yeah.
If you could let me know that'd be
Happy to do so. Sure.
Thank you.
Well, if I could just ask one question with Caleb, because Caleb, in this discussion, recommended a 3.75 spend rate to move forward. Well, what went into that thought process?
So our first comes our
If you wouldn't mind
expectation.
coming to the microphone.
That spend rate was based off of our expected return for your portfolio of 6.6%, and then just adjusting it down based on our expectations for inflation and fees so that the portfolio's asset base will be preserved on a real basis over time while supporting a spend rate. Does that make sense?
Yeah.
Yes.
No, yeah.
Carrie, is there a definition of safe harbor spend rate from the state of Ohio that we have to follow too?
Not that I know of for government, no.
This is the spend rate is important. This is how
Yeah.
we support our programming.
Right.
So
I know that that Nakubo white paper you mentioned is probably focused on higher ed, but I think it's informative if it can be forwarded to staff, so then we can also see that. And Tom, I think it does put us, we're smaller
I know.
compared to the Nakubo standards that.
No, I understand,
they
and I
look at
just, I'm doing that more so that I keep our foundation board and people interested in targets that we really, for what kind of and an important institution we are, we still have an incredibly small endowment, incredibly small for what we are as an institution and our importance to the civilization, if I can dare to use a word that other guy used recently.
okay.
Could I ask one more question, actually, of our PNC colleagues, of that 3.75 suggested spending rate? What are you seeing from similarly sized endowments and an endowment fee assessed to help us pay specifically for the administrative functions of fundraising and managing the endowment?
I mean, I think that answer would be best found if we were to do the enterprise financial modeling that Caleb mentioned.
Okay.
And that 3.75%, that's really a back of the envelope number. So it's
Right.
not specific to the library in a real sense of the word. And I would say that, I don't want to use safe harbor in the context of the state of Ohio, but 4% as a spending policy to allow for, the principal to continue to compound after distributions is kind of that's the most defensible spending policy. I mean, foundations have a 5%, but those are usually private foundations that have a required 5% spend rate.
Thank you.
Thank you.
Thank you, gentlemen.
Thanks.
Should we exit the stage left? Okay.
Thank you so much.
Thank you.
Nice
Thank you for
meeting
your
you.
time.
Thanks, Jim.
At this point, we'll go to the Finance Committee agenda. Exhibit 1 is a resolution to accept gifts for the month of March, whereas the board receives gifts of monies, library service materials, technology resources, and miscellaneous non-monetary gifts from generous citizens. Whereas attached to this resolution is a gift report itemizing gifts received by the library in the month of March 2026. Be it resolved that the gifts described in the gift report for March 2026 be accepted upon the conditions connected with said gifts, and with conditions connected with said gifts in accordance with section 3375.40K of the Ohio Revised Code. Carrie, what's our big new thing?
We received our first distribution from the Young Fund from Key Bank Trust.
That's great.
Mhm.
Without objection, I'll go to the full board for review. Do I have to take a vote here now? I forgot how we changed that.
Yes.
Is there a vote of the Finance Committee on Exhibit 1? It is so moved.
Second.
Ms. Bunce,
Yes.
Ms. Shakarian,
Yes.
and Mr. Morgan.
Yes. Exhibit 2 is a resolution to renew the maintenance agreement with Tyler Technologies for support and to update licensing of the enterprise ERP system. Whereas in March of 2006, the library entered into a system agreement with Tyler Technologies for maintenance of libraries' Munis ERP system, now referred to as Enterprise ERP, and continues to expand the functionality of the library's ERP system, implementing modules to improve efficiency. Be it resolved that the Board of Trustees authorizes Executive Director CSO to designate or designate to execute all documents necessary to renew the maintenance agreement with Tyler Technologies, subject to the chief legal officer's approval for the period beginning May 17, 2026 and ending May 16, 2027. The cost not to exceed $99,619.26, with the expenditure being charged to the general fund account 130-10053-53360, computer maintenance. And Carrie, this is one of the reasons that we keep getting awards for how we manage things.
Well,
correct?
kind of. This is our annual maintenance support agreement with Tyler Technologies. And this year, what we'll be doing is removing some of the modules that we are not using, like the applicant tracking we'll be removing. And we have also replaced our crystal reporting with like a TRS SSRS reporting system. And then also this year, moving forward and starting in May, we are implementing employee access, which will be replacing our employee self-service. So that is included in these maintenance fees moving forward.
Remind me how we do it. Where are we doing applicant tracking through? Is that? the
We are doing that
payroll
through the job fight.
Job fight. Okay.
Mhm.
So I would move Exhibit 2 for adoption on Thursday.
Second,
Ms. Bunce?
Yes.
Ms. Shakarian?
yes.
And Mr. Corrigan?
Yes. Exhibit 3 is a resolution authorizing agreement for managed print services, whereas on May 16, 2019, the board authorized the library to enter into agreements with Applied Laser Technologies, BSL Applied Laser Technologies LLC, ALT for short, for the lease or purchase of and maintenance to multifunction devices, desktop printers, and production print equipment. This board subsequently authorized renewals of the maintenance agreement with ALT on June 18, 2024 and June 17, 2025. Whereas where the current agreement runs through June 30, 2026, and the library received 5 technical proposals in response to our RFP, and the library selection committee determined that the proposals submitted by ALT and Canon were the most responsive to the requirements. Whereas the selection committee interviewed, conducted demonstration, and requested price proposals from ALT and Canon. Whereas the selection committee recommends that this board authorize the library to negotiate an agreement or agreements with Applied Laser Technologies to purchase new multifunction devices and pay stations, and to provide service and maintenance to libraries' multifunction devices, desktop printers, and pay stations for a 3-year term with 2 one-year renewal terms. Now therefore be it resolved that the board hereby accepts the recommendation of the selection committee, authorizes the executive director, CEO, or his designee to negotiate and execute an agreement with Applied Laser Technologies, BSL Applied Laser Technologies LLC, for the purchase of multifunction devices, printers, and pay stations for a total cost not to exceed $351,704.61, with such amounts being charged to the building and repair fund to capital outlay, which agreement shall be subject to the approval of the chief legal officer. Be it further resolved that the board further authorizes the executive director, CEO, or his designee to negotiate and execute an agreement with Applied Laser Technologies, BSL Applied Laser Technologies LLC, for the service and maintenance of the library's multifunction devices, desktop printers, and pay stations for an annual cost estimated at $87,294.22, with such amount being charged to the general fund 10053-53350, machine maintenance, and where the X's indicate the branch department where those devices are located, which agreement shall be subject to the approval of the chief legal officer. So moved.
I thought the pay stations were getting phased out when we had them. Or is this a different type of pay station? What's the pay station for? Yes.
Good afternoon. These space stations are cashless.
Right?
So
But we were offering free copies up to a certain level, right? And this is
That is
above
correct.
and beyond that?
and these will be for anything above and beyond the free copy
Okay.
levels that patrons will receive.
Gotcha. Okay.
We will revert back to our old policy,
Okay.
right, which was $1 per day.
Okay. $1 per day for a certain number of copies. I'm sorry.
I thought it was 5 copies free.
5 copies free, which is in essence $1 per day.
Okay, so 20 cents a page or something?
Yeah,
Huh?
that's pretty common market
No, I
price.
know, I was.
That's how much.
Okay,
No.
so what is
Yeah.
our policy now and
Fine.
then what are we going to, just so I understand that?
It's 10 cents per page, 10
10,
copies. All right. So, and the policy currently is 25.
Well, the policy in place is $1 credit per day.
Oh, a
Yes.
dollar credit per day.
And,
Okay.
and we temporarily changed that to 25 free prints through June 30th
Yes.
of this year.
I see. Okay.
And that dollar could be 10 cents per copy, or it could be 25 cents for 4 copies if they want color.
I see. Okay. Okay. So that is through the 30th. Does the board have to take action at our June meeting?
No, because we'll just be going back to the
We'll
old.
go back. Okay.
So what we were able to do was a temporary procedural
Mhm.
place while we were working through getting
I see.
these in order.
Okay.
So we've been able to now have a place where we're going to own these.
Do we have a sense of usage for people taking full advantage of their 25 right now? And I guess what's the impact as we move back to pay stations and for our patrons?
We
I
can,
haven't taken
Yeah.
usage of it, I just don't have the numbers.
That's
There it
okay.
we can generate that report.
Yeah.
The other question.
I just want to make sure there's some
Yeah.
accessibility addressed as we contemplate this change at the end of the fiscal year.
Yeah.
Or the,
And then
quarter.
if you were to estimate of the new equipment to being purchased, about $351,000 worth, what would be the majority of type of all these are so disparate type of equipments? What's the one that's probably the most numerous or the most expensive?
The most expensive would be the multifunction devices, which are in the branches and located throughout certain administrative areas here. The multifunction devices are the ones that are used by the patrons the most for copies, for printing, and for scan fax.
And those are the most expensive ones.
Correct.
And if you had to guess at the average age of the equipment that might be replaced, what would you guess at?
This purchase was last done in 2019, so we're at 7 years. The typical multifunction device or corporate printers are measured 3 to 5 years with a 5-year look to replace. Some organizations stretch them, as we did, and that was done intentionally because of the COVID loss in printing. So we were able to squeeze out a couple extra years and allow us to get a line for this large procurement.
That's great. Appreciate it. Exhibit 3 is so moved.
Second.
Ms. Bunce?
Yes.
Ms. Shakarian?
Yes.
And Mr. Corrigan?
Yes. Exhibit 4 is a resolution to authorize lease of space for Asia Town branch. Whereas in December 18, 2025, the board authorized the executive director, chief operation officer, and chief legal officer to explore the options and issues related to collaborating with Midtown Cleveland, Inc. and the NRP Group LLC to open an Asia Town branch in a new building to be built by NRP Group. And whereas NRP Group has offered to lease the space of the library through Midtown Lofts LLC, a separate entity created by them that will own the development for a term of 15 years at a rental rate of $1 per year. Whereas under the proposed terms, the library would be responsible for the cost of building the space out to suit its needs, which cost the library and the group estimate will amount to approximately $1.5 million, inclusive of furnitures, fixtures, and equipment. Whereas the administration is in the process of exploring various options for building the space out, whereas the Library External Relations and Development Department, in conjunction with the Cleveland Public Library Foundation, have already secured $600,000 in grant philanthropic pledge funds to go towards the build-out of Asia Town branch. Whereas the executive director and CEO recommends that as the board authorize the library to enter into a letter of intent and lease agreement with Midtown Lofts LLC in order to allow the library to take advantage of this opportunity. Be it resolved, the board hereby authorizes the executive director, CEO as designee, to execute a letter of intent in substantially the same form as is on file with the board secretary, and thereafter to negotiate and execute a lease with Midtown Lofts LLC consistent with said letter of intent, which lease agreement shall be subject to the approval of the library's chief legal officer, and which lease payments shall be charged to the general fund account 172-20053-53510 rent leases. Go
So
ahead.
what you have before you today is a lease agreement different from the others that the library currently has and is working toward. This is a $1 per year lease for 15 years, which is, I believe, the term of the NRP Group's low-income housing tax credit. So we would be coinciding with that. We would be responsible for the cost of the build-out of the space. We're in negotiations with NRP Group as to how that cost will be handled, how we will be paying it, because the intention is that NRP Group will do the construction on our behalf and deliver at the commencement of the lease a fully finished space. In addition to our $1 per year in rental payment, library will be responsible for our proportional cost of what essentially amounts to common area maintenance. So exterior lighting, trash removal, insurance, property tax on the space, and so forth.
Security.
And I can confirm on security. I'm not quite sure how that's handled for the building and if that's going to be a portion, if that's going to be included in what we're paying. But the overall amount right now is estimated at about $600 a month. So $7,200 a year plus $1 in exchange for the space.
And remind me, what do we think the square footage of the space will be?
Approximately 3,500 square feet. So I want to say it's just a little bit larger than Garden Valley.
I'll say a little bit larger than Garden Valley.
That's it.
And I know that we were successful in securing a grant, and there's other prospects lined up for the balance of what we anticipate.
Yes, it's part of our, this project is part of our overall fundraising strategy in which we have prospects for this particular project. And we're also meeting with people in the community in that area who have recommendations that they would like to give to Director Thomas and I.
Wonderful. That's good.
Thank you.
This is a very nice opportunity. I
Yes.
think.
Margaret Wong's still on our foundation board.
Yeah, well, she's already donated 100,000.
But anyway, so, do you know what the monthly rental on these, they say affordable, and I always wonder, what does affordable mean? I see they're 1 and 2 and 3 bedrooms.
I
And
don't-
each person, I guess, is coming up with 14,000 a year. How you figure what their rent is per month?
We're not the,
I'm
I-
just curious because.
I can find out how the rental amount for the apartments is calculated. This being a low-income housing tax credit funded building, I believe it's all part of the HUD regulations.
Right.
So it's generally speaking a portion, a percentage of what HUD calculates to be disposable income. So it will probably vary from individual to individual based on household income.
120 units.
Nice.
And they
Thank you,
have
Brian.
parking
You're
for
welcome.
135 spaces.
Yep.
So I move Exhibit 4 for approval.
second,
Ms. Butts?
Yeah.
Ms. Shakarian?
yes.
And Mr. Corrigan?
Yes. Exhibit 5 is a housekeeping regular, our Fourth Amendment to the year 2026 appropriation, whereas our revised code section 5705.40 provides for the amendment of appropriation measure when necessary, whereas the aggregate of all appropriation classification doesn't exceed the total amount submitted to the Budget Commission. Now therefore be it resolved that sums indicated on the attached Fourth Amendment to the year 2026 appropriation schedule be approved. So moved.
Second,
Nothing major, Carrie.
No, actually, it's just the appropriation for the multifunction devices, printers, and pay stations in the building and repair fund, and the amount of just over 351,000.
Ms. Butts?
Yes.
Ms. Shakarian?
yes.
And Mr. Corrigan?
Yes. That concludes the Finance Committee for April 2026.
Yay. Thank you. Trustee Shakarian? Please.
Yes, for the Human Resources Committee, I present Exhibit 6, a resolution to adopt a health savings account plan. Whereas on November 18th, 2025, the Board of the Library Trustees authorized the library to contract with Medical Mutual of Ohio for employee health insurance benefits for 2026. And whereas under contract with Medical Mutual, employees have 4 coverage options from which to choose, including a high deductible health plan, which has not previously been offered to library employees. And whereas high deductible health plans are health insurance plans that offer lower monthly premiums but carry higher deductibles and out-of-pocket costs compared to traditional health plans. And whereas unlike traditional health insurance plans, high deductible plans can be coupled with a health savings account, which employees fund through automatic payroll deductions on a pre-tax basis, and which can be used to pay for qualified medical expenses. And whereas the IRS rules require that employers adopt and maintain a written plan document known as a cafeteria plan that governs pre-tax benefits such as health insurance premiums, flexible spending accounts, and health savings accounts. And whereas the library administration desires to amend the library's existing cafeteria plan to include the health savings account plan attached to this resolution, now therefore be it resolved that the Board of Trustees of the Cleveland Public Library hereby adopts and approves the attached health savings account plan, which adoption and approval shall be retroactive to January 1st. So, Brian?
So what you have before you today is another piece of the library's cafeteria plan that already includes our medical cost program and our flexible spending account plan. Really a formality to comply with the IRS rules so that employers are able to contribute on a pre-tax basis to the health savings accounts that they can couple with their high deductible health plans as a way of saving on rising medical costs. You're welcome.
I have a quick question, and that is at no cost to the library, correct?
Correct.
And I know that's something that we have to do to be in line with what the government is expecting of us. How many of our employees are already enrolled in the HSA?
I can find that out.
I'm just wondering roughly. How many? 11?
So 23, 12 family, 11 single. Yeah, so
23.
23, yeah.
So this is at no cost to us, because it doesn't seem like there's gonna be,
Oh, no.
if we have such a low number of employees already.
So,
Yeah.
the way the health savings account works, or the way the health savings account plan works, is a pre-tax deduction. So the employee fills out a form just like they wanted to contribute to their FSA, and they're specifying how much, if anything, they want taken out of each paycheck and sent into their HSA plan. Now for 2026 only, and like I said, it would be up to the plan administrator to decide if we want to continue this in the future. But for this being our first year with the HDHP, the high deductible health plan, and the health savings account, the library was contributing $500 into individual HSAs and $1,000 into family HSAs, but that's only for 2026.
No, I'm just asking, because I remember when I was working, how many people did not invest in those? And if it's gonna be costing us money, and we have a very small amount of staff that are enrolling in that. it's not
Yeah,
beneficial.
I think Ronell will be the benefits person to say that the 23 people are really pleased with having this opportunity to do it. So that's kind of thing, and it's not, other than the amount that we're committing this year, it doesn't cost us anything. It just gives more options for folks as they choose their insurance.
And is there just between bargaining unit, non-bargaining unit employees on this?
It's available to both.
It's
That's what I
available to
thought.
both, yeah.
Okay, I just wanted to make,
Yeah.
I knew that was the case. I wanted to make a record for that.
Yeah.
Thank you, Brad.
So
You're welcome.
moved.
Second,
Ms. Bunt?
Yes.
Ms. Shakarian?
Yes.
And Mr. Corrigan?
yes.
And I present Exhibit 7, the regular employment report. So moved.
Second,
Ms. Bunt?
Yes.
Ms. Shakarian?
Yes.
And Mr. Corrigan?
yes.
And I present Exhibit 8, Retirement Recognition Citation. A citation has been issued for the following staff member on the occasion of their retirement. We have Jim Bettinger, retiring after 31 years, Senior Subject Department Librarian, Science and Technology, as of April 30th. Be it resolved that the citation for the above staff member presented by the Board of Trustees in appreciation of their faithful and dedicated service given to the library be recorded in the minutes of this meeting, and be it further resolved that the citation be sent to them forthwith. They are not present at this meeting of the Board of Trustees. I understand Mr. Bettinger may not be available for our board meeting, so we will present that citation and then make sure he gets it. So moved.
Ms. Bunt,
Yes.
Ms. Shakarian,
Yes.
and Mr. Morgan.
Yes.
We did talk to Jim. Yes. John is going to say something.
Wonderful, wonderful. And that concludes the Human Resources Committee report.
Okay. I don't think there's any other information, so at this time, I call the meeting adjourned.
Thank you.
So Melanie,